April CPI data numbers. I think it's Rick, is it Santelli? Yeah, Rick Santelli, the numbers, please.
The numbers, please. And here they are, our consumer price index for the month of April. Headline, expected up 0.2 is up 0.3. And do remember, this is a big drop from up 1.2 last month, which was the highest since 2005. If you strip out the all-important food and energy, expected up 0.4, a bit more, up 0.6. The high water mark here is up 0.9, and that was in April of last year, and that went back to 1981. And the Moneyball year-over-year headline up 8.3%. It breaks the streak of 7 higher year-over-years in a row, because in the rearview mirror we have 8.5%, and of course 8.5% takes us back 4 decades. It is a small reprieve, but a reprieve nonetheless. And if we look at core ex-food and energy year over year, same dynamic. It's higher than the 6% expected, Joe. It was up 6.2. 6.5 in the rearview mirror is the highest since 82. So we've definitely moderated just a bit. We see interest rates, well, they have changed rather dramatically. Rates across the board pretty much, and especially the long maturities, have moved higher from down 5 to up 4 or 5, over 3% again on a 10-year. And the reason is quite obvious, is that even though there is moderation, the moderations are small, but we do want to keep a very close eye on several things here. And the first, of course, is that food and energy really did throttle up to the upside. So when we looked at headline, when you stripped out food and energy, the fact that it moved up showed us that those moderated a bit in the headline number. Yesterday, what did we learn? $4.37 a gallon. That's a new high for gas. So some of that feature of energy prices moderating a bit may be something tenuous at best. I'll kick it back to the team to discuss some of these numbers.
Well, we have some really eminent guests, but I got to go to Mike first, because the market reaction has been swift. We talked just a few minutes ago, Mike Santoli, about whether it was asymmetric risk. I think it was asymmetric. There was nothing that was going to make people happy, and it was not as much of a respite, I think, as we had hoped. The market immediately sold off.
Yeah, I'm not sure about the counterfactual. If we somehow got a light number, I think the market would have embraced it. The issue is in the previous days, last few days, you actually have seen yields come in. You've seen market implied inflation projections. They're imperfect measures, but you did see people moderating their expectations for what inflation would be down the road. So leaning on that foot, I do think the number comes as an unpleasant surprise. Now, you can still start talking about whether we're past the peak of inflation, but today's number doesn't settle that in any satisfying way. So I think we're stuck with kind of the same market and the same drivers that we thought we did, a couple of weeks ago.
We'll never know the counterfactual, but see, I think that the market was looking for a respite and then assumes we're going back up. So I don't know if it could have been cool enough to really, because the market would have then said, well, it's going back up. I don't know, but we will never know. Tyler Goodspeed, what do you? This is a 30 or 40 year change in what we've come to expect. So it is jarring.
It is jarring. And Joe, I wish we'd had a chance beforehand. I was going to say, I'm going to take the over on this one. Look, I have a couple initial reactions. One is there go real wages for the month of April. The second reaction is that there were some transitory factors that were actually bringing this number down. I'm looking at used cars, which were down 0.4 of a percentage point. There are some base effects that weighed down on inflation last month. But I think that it's a mistake to be looking at a lot of individual components, because the bottom line is this is a broadening inflation problem. When you look at any survey of businesses, any survey of households, expectations have risen. And I think that we're seeing a real broadening of the inflationary pressure, particularly with rent up 0.6 and owner equivalent rent up 0.5. Those are big components of core CPI.
Austin, we all have our own biases, and I know you'd like to be sanguine or happy, but you're always pretty honest as far as because you're an economist. I mean, you see the numbers, and it's just hard to make them look nice, right? Tough.
Yeah, look, we shouldn't describe it as anything other than what the facts are. I mean, hopefully this indicates we hit peak inflation in the past. It's down. It's not down as much as we wanted or we expected. It's in the context that in Europe, because of these energy and food components, their inflation's going up even more. But I think, on those components, we're likely to continue to have some bumpy ride.
So it might just be worth clarifying on this, because yes, in the past couple months since the Russian Federation's invasion of Ukraine, inflation has gone up by more in Europe. But if you look at a harmonized index of consumer price inflation in the euro area and in the United States, in the 12 months through February 2022, inflation, the increase in the rate of inflation in the United States was more than 5 times that in the euro area.
That's through February. And that's not taking into account what I just said, which is if you look at the energy and food since the accumulations of troops around Ukraine, you've seen in the last 2 months inflation going through the roof in Europe. And so compared to that context, it is a little better in the U.S., but it's still not where we wanted it to be.
Tyler?
Right, and I'll agree with that. It's just that in terms of the underlying inflationary pressure that's been building in the U.S. versus elsewhere, it's a lot more broad-based and much more at the core level.
Steph, I'll get to you in a second, but I just want to just drill down on this a little bit more. So, Tyler, do you blame fiscal 1.9, I don't know, whatever we spend in the Rescue Act, do you blame that? Do you blame an over-accommodative Fed? Where do you place? Or, I mean, there's reopening, there's the pandemic, there's supply chain, there's a lot of blame to go around. Where do you put the blame?
There's a lot of blame to go around, and Austin's right to note that in the euro area, food and energy have been a big deal in the past couple of months. But in terms of the underlying inflationary pressure, the real divergence between the United States and the euro area occurred in March 2021. They had been running even. If you look at a harmonized index of consumer price inflation, actually inflation in the United States was a little bit below the euro area through February 2021. It was in March 2021 that the divergence just exploded. And I think that's because we had a demand stimulus equal to about 10% of the U.S. economy. And demand for goods just took off in March 2021, growing at an annualized pace of 240%. That's a lot of demand to be pouring on a supply side of the U.S. economy that was still recovering.
Maybe it was necessary, Austin, with given what we were going through, or no?
Well, look, rather than argue about what happened more than a year ago, and emphasizing that if you look at the producer price side of inflation, it's up everywhere in the world more than on the consumer side, and it's up more in Europe and Asia than in the U.S. Instead, let's say if your fear was demand driven from stimulus, then you should be fearing deflation this year, because if you look at the GDP numbers, we now roll off the stimulus and it cut 3 percentage points off GDP growth. I don't think that demand stimulus can explain the continuation of inflation. I think for that, you've got to look at the supply side.
It's called the trade deficit. It's called the trade deficit. We want imports so badly. That spells demand. D-E-M-A-N-D, import demand.
Also, look, I mean, inflations are a function of inflation expectations and cost push and demand pull factors, and inflation expectations have now risen. Inflation expectations have now risen.
Stephanie,
they have not risen to 8%.
Before Rick got in, this was my next line to you. Stephanie, I want to get to you, but I really want to let Rick pile on with Austin if possible. So maybe we'll get. I'm kidding, Austin, but we'll get back to sort of. We'll get back.
You're not kidding.
We'll get back to that. Stephanie, what do you do? I mean, would you change what you said earlier for how to position yourself now?
No. Look, the last couple of days, Mike said it best, I think, that there was chatter that we were going to say, oh, this is the peak. The number was going to be so much lower than expected, and it was going to be a surprise, and then stocks could rally, and that's actually not happening. I mean, no matter what, as I said earlier, that inflation is high. Even if this number came in better, it's high, and it's going to stay high for a very long time. And I'm more worried about the wage side and the rent side of inflation, because I think that's much stickier. And we've seen a lot of various different data points that suggest that we are seeing a lot of inflation on the wage side, right? So wages are up 5.5%. Unit labor costs are up 7.3%. These are year over years. Employment cost index of 4.5%. These are huge, huge, huge numbers. And my point about mentioning this is that I don't think the Fed can really do anything unless they put us into a big recession. That's possible, to get this inflation down. And on the rent side, I mean, the Dallas Fed, they're talking about next year seeing rents up about 6.5%. I think you're going to see a lot higher because we know rents follow housing, and housing is up huge in terms of prices. And so, this is a really challenging market. We've seen multiple contraction. We've talked about that all year long. We went from 21.6 times on the S&P 500. We're now at 17.3 times. We could go back to the average of 16 times or even overshoot for that matter. So that's on the downside. And the fact of the matter is we have all these uncertainties, and unless you resolve one or all of these uncertainties, which we're not in the near term, you're not going to see multiple expansion. So therefore, you're in a trading range. Okay. I would still look for quality companies, free cash flow companies, good balance sheets. A lot of stocks are on sale, but you don't want to go all in. So that's kind of what I've been doing. I've been nibbling on the margin, definitely on the services side of the ledger, but also just quality and some growth names that I think are just way oversold.
All right, Rick, you've had plenty.